Welcome to the Deep Dive. Today we are taking a stack of sources focused on an investing figure. Maybe less famous than Benjamin Graham.
Definitely less famous, but arguably just as influential in a different way.
Right, Philip Fisher. The man whose ideas, they form that crucial 15% of Warren Buffett's strategy.
That's it. The 15% that really led to that massive, long-term, market-beating wealth.
It really is the difference maker, isn't it?
It absolutely is. It's the thinking that helps an investor move beyond just buying cheap stuff.
Just assets on sale.
Exactly. And start buying truly wonderful businesses. And that's really our mission here today, to sort of dissect Fisher's thinking, that qualitative core.
Yeah, understand why he argued that real safety. It wasn't about a low stock price.
No, it was found in the quality, the intrinsic strength, and crucially, the long-term growth path of the business itself.
And the origin of this idea, this deep conviction, it's actually rooted in, well, a pretty traumatic event.
You're talking about the crash.
Exactly. Fisher, he wasn't from poverty or anything, but he was restless. Dropped out of Stanford Business School in 28.
Yeah, took a job as a securities analyst at the Anglo-London Bank in San Francisco. Wanted to be where the action was.
Which, unfortunately for him, put him right at the front lines for the 1929 crash.
And the whole decade of the Great Depression that followed, he saw it all firsthand.
Saw companies that looked solid, on paper.
Completely wiped out. Not just a dip in the market, but like permanent destruction of capital.
And here's the key thing, I think, that set him apart from the Graham School.
What's that?
He saw that just being quantitatively cheap wasn't enough. He saw stocks trading below book value, below liquidation value.
The classic bargain stocks.
Right, the definition of a bargain. And they still got obliterated. Their cheapness wasn't protection.
It was a symptom of a fundamentally weak business underneath.
That's where his big realization came from, his never again moment.
The crash taught him the real risk wasn't, paying a little too much for a truly great company.
The real risk was
owning a mediocre one, something that just wouldn't survive a major crisis. And that idea, that's the seed, right? Redefining safety.
From Graham's numbers
To Fisher's qualitative strength, business durability. You could call it a margin of survival.
That conviction must have been incredibly strong. Because think about it, 1931, the absolute depths of the Depression.
Banks failing, everyone's terrified.
And that's when he starts his own investment firm, Fisher & Co. Talk about contrarian.
It's incredibly audacious, really, betting his entire career on finding this tiny handful of truly outstanding businesses when everyone else saw only ruin.
It really sets the stage perfectly for that big clash of ideas in investing.
The quantitative analyst versus the business philosopher, Graham versus Fisher.
Let's break that down because it's so fundamental. So you got Graham.
The quantitative king, core idea. Safety through numbers. Buy $1 for 50 cents. That's your margin of safety.
His ideal company, the famous cigar butt.
Right. A stock so cheap, there's one last free puff left of it, even if the business itself is dying.
And you sell when?
When the price gets back to what your calculation says it's worth, then you move on.
Okay, then there's Fisher. Totally different angle.
Completely. His core principle, qualitative growth. He wasn't after $1 for 50 cents.
He wanted
$1 that could turn itself into $5.
Right.
Or 10 or more over the long haul.
So his ideal company wasn't a cigar butt, it was a
compounding machine, and his ideal holding period.
almost never sell.
Exactly.
That compounding machine idea is really the heart of it all, isn't it? Explain that cycle. And why did Fisher think dividends were actually a bad sign? Graham loved dividends.
Right. Big difference there. For Fisher, a truly great company is always finding ways to reinvest its profits back into the business. But here's the critical part. It has to earn extraordinarily high rates of return on that reinvested capital.
Like way above average.
Way above. If a company can earn, say, 30% on the money it plows back in, why would management just give that cash back to shareholders as dividends?
Yeah, the cash is worth more inside the company, fueling more growth.
Precisely. It's better used for R&D, expansion, widening that competitive moat. So for Fisher, paying out big dividends often meant management had run out of great ideas, run out of high-return places to put the capital.
So it signaled a lack of internal opportunity.
In a way, yes, a sign of slowing growth potential, perhaps.
Okay, so connecting this to Buffett, he famously said he's 85% Graham, 15% Fisher. The Graham part taught him to look for value, for a discount.
Right, don't overpay senselessly.
But that Fisher, 15%,
Yeah.
that gave him the intellectual framework to look beyond just cheapness, to look for quality.
Exactly. It allowed him to shift from buying, those failing textile mills just because they were statistically cheap.
To buying companies like Coca-Cola or See's Candies. Wonderful businesses.
Wonderful businesses. Even if they weren't dirt cheap by Graham's standards, that 15% gave him permission, you could say, to pay a fair price, sometimes even a high price, for outstanding quality.
Because the quality itself was the ultimate safety.
That was Fisher's core belief. Quality equals safety.
Okay, so Graham had his balance sheets, his earnings statements, all backward-looking data, really.
History, yeah.
What was Fisher's main tool for figuring out the future path of these compounding machines? How did he assess that quality?
This leads us to the most distinctive part of his method. The most famous part, maybe.
Let me guess. Scuttlebutt?
You got it. The scuttlebutt secret.
It's such a great name, like sailors gossiping around the water barrel.
That's the origin. But don't let the name fool you. It wasn't just casual gossip. It was a really rigorous, structured approach. An attitude, almost.
Some attitude of curiosity.
Relentless curiosity. A structured way to gather information that Wall Street analysts, back then anyway, couldn't get or just wouldn't bother trying to get.
Because it wasn't in the official reports.
Exactly.
Oh.
Fisher understood that annual reports, press releases, they're polished. They tell you where the company has been, usually in the best possible light.
Right. Marketing documents, essentially.
To figure out where it's going, you had to get outside the official channels, bypass the CEO's scripted answers. You needed external validation, real-world checks.
Okay, that sounds great in theory, but let's push back a little. For the average person listening today, with Reg FD and all the compliance rules.
Right, you can't just call it management like you used to.
Exactly. So doing scuttlebutt sounds like something only a big hedge fund with tons of analysts could possibly do.
Yeah.
How realistic is this for an individual?
That's a really important question. And I think the key is understanding it's less about, getting secret meetings and more about adopting the attitude.
Mindset.
The mindset of relentless curiosity. Fisher wasn't really after illegal insider info. He wanted accurate external perspectives, things that revealed the operational reality, the culture, the competitive standing.
Okay.
And he had specific ways of getting that. 5 key channels, he called them. And these channels, or the modern equivalents, are often still accessible, maybe digitally, maybe indirectly.
All right, let's walk through that fieldwork. What were the 5 channels and why each one?
Okay, first, competitors.
Makes sense. Who knows your weaknesses better?
Exactly. They give you the unfiltered view. Maybe slightly biased, sure, driven by envy sometimes, but incredibly insightful about a rival's real strengths, their weaknesses, and especially their pricing power. You learn a lot from people trying to beat them every day.
Okay, channel 1. Competitors. What's 2?
Customers. They're the ultimate judges, right, of the product, the service, the competitive advantage.
How would he approach them?
He'd ask things like, would you switch if competitor X offered something similar for 10% less? The answer tells you volumes about brand loyalty, about whether the company has a real moat or if it's just competing on price.
Okay, got it. Customers. 3rd.
Suppliers. They offer a unique window into things the balance sheet just won't show you, like operational efficiency.
And integrity, too, maybe.
Absolutely. Do they pay their bills on time? Are they fair partners? Or do they constantly try to squeeze every last penny out of their suppliers? That says a lot about the long-term character of the management.
Okay, suppliers. That leaves 2.
The last 2 are really about the human element, which was huge for Fisher. Former employees.
Ah, the ones who can talk freely.
Exactly. Once they're out, they often give you candid, unvarnished views on the company culture, the leadership quality, morale. Is it a great place to work where talent stays, or is it a revolving door?
That's clever. And the 5th channel.
Industry experts. Academics, consultants, trade journalists, people who don't work for the company, but whose job it is to understand the whole sector.
They provide the big picture context.
Right. Technology shifts, regulatory changes, future trends, they help you see the forest, not just the trees.
So scuttlebutt wasn't just random conversations. It was a system.
A qualitative system, absolutely. Designed to stress test the durability of that competitive advantage, the moat, before you put your money down. It was about figuring out if that castle was built on rock or on sand.
That level of homework. Wow. It sounds exhausting, but I guess that's what earns you the conviction to hold for potentially decades.
It's the foundation for that conviction.
And Fisher didn't just practice this. He wrote it down. In his 1958 classic, Common Stocks and Uncommon Profits, he laid out his famous 15-point checklist.
Right. And that checklist, it wasn't about financial ratios so much. It was really about finding companies where growth was like a human achievement, an organizational success story in the making.
You can group those 15 points into themes, right?
Definitely. There are sort of two big buckets. The first is what you might call the engine of growth.
The mechanics of expansion.
Exactly. Points about market potential. Fisher wanted a long runway for growth, that's point one, and a huge focus on R&D effectiveness, point three. He knew growth wasn't just about past success.
It was about the pipeline. What's coming next?
Constantly. Is the R&D effort actually producing things that will drive future sales and profits?
And that R&D links directly to point 6, right?
Yeah.
Maintaining profit margins.
Absolutely. If your R&D creates truly unique, valuable products or services, you're shielded, at least somewhat, from brutal price competition.
Which keeps the margins healthy.
And keeps that compounding machine fueled with high return capital to reinvest. It's all connected.
Okay, that's the growth engine. What's the other big theme in the 15 points?
This is what really, I think, sets Fisher apart, especially from Graham. It's his deep focus, almost an obsession with people and culture.
The human side of the business.
Totally. Points 7, 8, and 9 look hard at labor relations, executive relations, the depth of the management team. For Fisher, things like poor labor relations weren't just a PR problem.
They were a red flag.
You have a huge red flag, a ticking time bomb, potentially.
Why specifically labor relations? Why give that its own point?
Because he believed a stable, skilled, motivated workforce is fundamental. It's the backbone of consistent quality, operational excellence.
If there's constant conflict.
Constant fights with the union, high turnover, low morale. That friction eventually shows up. It hits the product, the service quality, and ultimately the bottom line. Plus, it signals management might be distracted, maybe even arrogant.
So the numbers, for Fisher, were just the result. The output of a healthy or unhealthy human system.
Beautifully put, yes. The human system creates the financial results.
And then there's point 14, which feels like the ultimate character test.
Oh, absolutely. Point 14 basically asks, does management talk freely and openly when things are going great?
But then they clam up?
But then they clam up, get defensive, or hide when troubles or disappointments inevitably happen.
So integrity isn't tested when everything's booming.
No way. It's tested during the tough times. Fisher believed you absolutely had to have a management team that was transparent and forthcoming about failures, about setbacks. If they try to hide the bad news,
they can't be trusted.
Fundamentally untrustworthy with your capital, period.
Okay, so let's say a company passes this incredibly high bar. You've done the scuttlebutt, you've checked the 15 points, you believe in the culture, the moat, the integrity.
You found one of the rare gems.
What then? What's the holding period for this amazing business you found?
Here comes his most radical rule. You sell almost never.
Almost never. That sounds extreme.
It was, compared to conventional wisdom then and even now. He saw most selling, most trading as just noise. Activity for activity's sake.
Driven by emotion, maybe. Short-term market swings.
Exactly. Fear or greed reacting to headlines. He believed strategic patience was paramount.
But hang on, holding for decades. What about opportunity cost? Graham would say, sell that stock when it hits fair value, buy another cheap one. You could compound faster that way, maybe.
That's the core philosophical difference again. Fisher understood or believed that the truly massive life-changing gains don't come from flipping moderately undervalued stocks. They come from the exponential phase of compounding, the part where the curve goes almost vertical, and that often doesn't really kick in powerfully until year 10, year 15, maybe even later.
So if you sell early?
You interrupt that compounding, you miss the really explosive growth phase, and you trigger taxes. He saw selling a great business too early as just shooting yourself in the foot financially.
Okay, but almost never can't mean literally never. Surely there were times he thought selling was right.
Oh, for sure. He wasn't dogmatic to the point of absurdity. There were 3 clear, logical exceptions. Reasons to sell a wonderful business.
Exception number 1.
You realize you made a mistake in your initial analysis, a factual error. The company simply isn't as great as you originally thought. In that case, admit the mistake, sell, learn from it.
Okay, reasonable. Number 2.
The company fundamentally changes for the worse. Maybe the moat gets eroded by new competition. Maybe disastrous new management comes in and wrecks the culture. Maybe the key technology becomes obsolete.
The business no longer meets the original 15-point standard.
Precisely. The reasons you bought it are no longer valid. Time to sell.
And the third exception. You said it was a really high bar.
Extremely high.
Yeah.
You find a truly, demonstrably more exceptional opportunity elsewhere. But he emphasized truly exceptional.
Not just something that looks slightly better on paper.
No. You had to be convinced that the new opportunity was so much better that it justified paying the transaction costs, paying the capital gains taxes, and crucially, resetting that compounding clock. It was a very, very high hurdle to clear. It rarely happened for him.
We absolutely have to talk about Motorola to see this in action.
The classic Fisher case study.
He bought it in 1955. Back then, it was mostly making radios, maybe some early TVs. Wall Street probably saw it as just another industrial company.
He was stable, maybe a bit boring by their standards. But Fisher's scuttlebutt, his digging, it uncovered something much deeper.
What did he see?
He looked past the current products. He saw the culture. He saw an innovation engine. A management team obsessed with R&D, constantly adapting, willing to make their own successful products obsolete if they could invent something better.
So he wasn't buying a radio company.
No, he was buying its potential, its trajectory towards things like integrated circuits, semiconductors, mobile communications, things that maybe weren't even fully imagined yet in 1955.
And the conviction required to hold. He held it for how long?
49 years. From 1955 until he passed away in 2004. Think about the market crashes, the recessions, the tech scares he held through.
That's incredible patience.
Yeah.
What was the final result? Give us the number.
It's staggering. Every $1,000 he invested in Motorola in 1955 grew to $1,993,846 by 2004.
Wow. Almost $2 million from 1,000.
That's the power of identifying a truly wonderful business and then having the conviction, the patience to let the compounding work its magic over decades, even when the stock often looked expensive by normal metrics.
There's another great example, too, showing his strategic thinking. Corning Glass Works.
Ah, yes. Another fantastic one. Post-World War II, the TV industry is just booming, right?
Right.
Everyone wants a television.
So first-level thinking says, buy the companies making the TVs. RCA, Zenith, Admiral.
Right. But Fisher looked deeper. He saw that making the actual TV sets was going to be brutally competitive. Cutthroat price wars were inevitable.
So he used his scuttlebutt again.
He did. He analyzed the whole supply chain, the whole ecosystem, and he asked, who's the essential supplier? Who benefits no matter which company wins the TV set price war?
And the answer was?
Corning Glass Works. They had the specialized technology, the patents, to make the glass picture tubes needed for every single television set being made.
Yeah.
They were indispensable.
It's the classic picks and shovels play.
Exactly. During a gold rush, don't dig for gold, sell the picks and shovels to all the miners. Corning was selling the essential shovel to the entire TV industry. This shows how scuttlebutt wasn't just about one company, but understanding the whole industry structure to find the most defensible, profitable position.
Okay, let's try to wrap this up. Bring Fisher's legacy into focus for today. Graham. He was perfect for the industrial economy, wasn't he? Focused on hard assets you could count.
Tangible assets, right. Inventory, factories, equipment on the balance sheet. Graham's methods were optimized for that world.
But Fisher, he seems optimized for our world, the information age, the tech economy.
I think that's exactly right. He shifted the focus away from just the tangible assets towards the intangibles.
Like R&D strength.
Brand power, management depth, that crucial element of corporate culture. These things don't always show up clearly on a balance sheet, but they drive value creation in today's economy.
Which makes his 15 points focus so much on people, culture, and innovation, maybe even more relevant now.
Arguably, yes. More relevant today than when he first wrote them down in 1958. He was ahead of his time in understanding the qualitative drivers of long-term growth.
So he wasn't just picking stocks, he was really a business philosopher who taught us how to identify companies capable of compounding wealth internally over very long periods.
He provided the intellectual bridge from Graham's value focus to modern growth investing.
And that leads us to our final thought for you, the listener, to consider.
Fisher warned about this constantly. Selling a great company just 10 or 15 years into owning it, you often miss the biggest part of the gains.
You get out right before that compounding curve really takes off, goes exponential.
You capture the arithmetic returns, but you miss the geometric explosion that comes later.
So the question to leave you with is about the real cost of being too active, of trading too much. Ask yourself, what truly great companies might you be selling too soon, right before the best part of the journey even begins?
Something to think about.
We'll see you on the next Deep Dive.